Hey everyone, Michael here. So in this video, we're going to walk through the NVDA company report and I'll share with you the insights that I'm gaining from looking at it. So for starters, just to give some context as to why I'm here, I have NVIDIA on my watch list and I've been watching it for quite some time because I think it's a really interesting business. And so it's been showing up on my dashboard and I've been receiving updates about it and I've been reading the articles and I'm very interested in the stock. And so the reason why I'm looking into it now, again, is because basically I got this update that there's an upcoming dividend of 4 cents per share. And so in order to be eligible to receive that dividend, this update told me that I need to own the stock before December 1st, 2021. And the pay date's 23rd of December. So I was looking at that, I was like, okay, I'm interested, and started researching it and reading some articles. And some of the more context I got about it was some reading some of the articles written by the analysts at Simply Wall Street. So there was an article written by one of them recently and basically looked into the insider selling that's been occurring from some of the management team. And ultimately the takeaway was that the company has had stellar performance and it was really knocked it out of the park with its performance. And the insider selling that has been occurring isn't too much of an issue considering how small it was as a percentage of their holding. So that was an interesting takeaway. I was like, okay, there has been insider selling, but it's not too concerning. And the underlying business is performing incredibly well. So there's not too much that I was concerned about there. The other article that I was reading was talking about valuation, and this was written by another analyst we have, and they basically went into the fact that while the company and the share price has performed incredibly well recently, and it seems to be tied a bit to the hype around the metaverse and the idea of gaming and data being such a huge part of this, such a huge growth industry and such a huge part of this stock's business, this particular stock has performed incredibly well. It's risen so much in just the last couple of months, and therefore, while the underlying company has performed well, it seems like ultimately the share price has actually outpaced the underlying earnings growth. So there's a lot of optimism baked into the price, and it seems like the basically expectations are very, very high. So in terms of buying into stocks and stuff, if you were to buy when expectations are sky high, there isn't much room for error. So basically, you want to buy when there's underappreciated expectations of a stock's future performance. But in this case, it seems like expectations might be sky high, so there's not much room for error. So reading those articles, I'm now going to have a look at the company report. Now that I got context about the insider selling and context about the ultimately the valuation, I want to have a look at this business and have a look at its dividends, see if it is maybe worth buying before the upcoming dividend, or if there's better opportunities out there, and just see if it's worth taking a position now. So like most stocks, I start here at the top with the snowflake. And so just having a quick look here, I can see that the company performed impeccably well in the company's financial health and its past. So it has a really strong and solid balance sheet, an amazing track record, flawless. It has good growth prospects, but not perfect. It doesn't seem to be good value at all, and the dividend doesn't seem to be noteworthy at all. So that's a very insightful takeaway from the snowflake here, and already I've gained that in just a couple of seconds by looking at that. So to get more color on that, basically I'll read through this company report and see the specific metrics that it does well in and where it doesn't. So the next part I look at is the risks and rewards. So I can see here that for one of the rewards, earnings are expected to grow at 17.5% per year for the next couple of years. And that's pretty good earnings growth, but it's not exactly the highest earnings growth. We were just looking at the other day at other companies like Amazon and Tesla, and they have higher earnings growth. So I wonder if this is enough to justify the current valuation it's trading on, which is kind of what that analyst before was alluding to. So I'll get into that in just a second. And the other reward is the company's earnings growth was 112% last year over the past 12 months, and that's just insane. So that probably helps attribute why some of the share price growth has occurred, because it's just been incredible performance. And so as for the risks, it says that there's significant insider selling over the past 3 months. And like I said, that article alluded to it, showed me a bit of the details about it, and basically said underlying performance is great, and the shareholder selling wasn't that much in terms of their overall holdings. So it wasn't too much to be concerned about, which is great to see because it provided some context about it. So the next step I look at is the competitors to NVIDIA. So here we've got the likes of Broadcom, Qualcomm, Intel, and Advanced Micro Devices. And I just want to see what the other opportunities are out there, because obviously I'm interested in NVIDIA. I think the gaming and data space and the metaverse space will be really big opportunities, and a company like NVIDIA is set to benefit from it. So it's not the only one out there though. There is the likes of these companies here. And so I don't want to put my blinkers on and not look anywhere else. I want to consider what other opportunities are out there because there might be better alternatives. So looking at these snowflakes here, I can see that I can learn a bit about these businesses as well. So while NVIDIA has a flawless balance sheet and really solid track record and okay future prospects, the likes of Broadcom has a much better dividend, okay track record, okay balance sheet, mediocre future prospects, and doesn't seem to be good value. Qualcomm seems to have a really good dividend, pretty good balance sheet health, good track record, mediocre future prospects, and doesn't seem to be good value at all. Whereas Intel, which is a stock we covered just the other day in a recent video, seems to be really good value, really good dividend, and a pretty solid balance sheet, okay track record, but it doesn't seem to have very good future prospects at all. And we covered that in that other video, which we'll leave a link to in the description below. And Advanced Micro Devices seems to have another flawless balance sheet and incredible track record and okay future prospects with not much good value and not much of a good dividend. So very similar to NVIDIA in that sense. So part of my process is basically I'll keep NVIDIA on my watch list, but I'm also going to look at these other stocks because it's not the only one in this space. And these other competitors might be worth my time. So I'll look into them after the video. I'll look into them and their company reports just to get some idea on how they're going. So the next part of my process is basically looking at the price history and performance, and more importantly, the updates that the underlying company has. So in this part of the report, we have all the different developments that the company's had. So you can see here with these colored dots, we have some financial updates, management updates, strategy updates, and anything else. And I read through these basically over the last 3 years just to get an idea of what's been happening, what projects have been going on, and how the company's been performing. And because sometimes they work on projects here that are multi-year projects, and they initiate something that they start, and it only starts contributing to the bottom line around here. So I'll read through just to get some context on the underlying business and see what's going on. And the next part is very similar to that too. So it's the recent news and updates. And I read through this just again to get a qualitative understanding of the company, and just to learn a bit about what's going on and get some context around it. So as I saw in the dashboard that I was looking at the start, the company has an upcoming dividend. So that's what got my attention initially to look into the stock again now, considering it's on my watch list. And also I read through here just to get all the updates of what's been happening, similar to the above, but more tailored and specific, because those above are company releases, whereas these are pieces of analysis provided by Simply Wall Street and their news team, and also some partnerships they have with the likes of Seeking Alpha. So you can read these pieces, and these are opinionated pieces from other authors, and they can shed some light as well. And I've mentioned in other videos, but it's very useful to look at these kind of things because reading stuff that is only supports your thesis can be very damaging, right? If I'm very bullish on a stock and I only look for confirmation bias and basically only look for stuff that confirms my belief, that's confirmation bias, and ultimately I'm setting myself up for failure, right? Because I'm not considering any of the other alternatives that are out there, alternative opinions that are out there that could actually have some truth to them. So what I find really valuable is to read through the opposing opinions, right? If I'm bullish, I want to look at who's bearish and why. And if I'm bearish, I want to look at who's bullish and why. And then that way I have a very detailed opinion or informed opinion of all the reasons to be optimistic and pessimistic. And then I get to make my own judgment as I learn more about the business of which outcomes I think are more likely. So I might look at the bearish outcomes and think, okay, yeah, that is possible, but I don't think those are likely to happen. I think it is more likely to be successful in these aspects because of this X, Y, and Z. So that's why I am bullish, but at least I've looked at the alternative and I've considered the inverse and why I could be wrong. So that's what this section is really useful for, and you can look it through, see all the updates, and basically look even further back into the past and have a look down here as well to see what's what. So that's what that part's for, and I'll go and do that after this video. So the next part I look at is just the shareholder returns, and I try and get an idea of how the company's performed versus the market and industry that it's in. And I can see here that the US market has performed really well over the past 12 months. 26% gain is nothing to turn your nose up at. That's really good. But the US semiconductor industry and NVIDIA itself have just smashed it out of the park. So 60% gain in the US semiconductor industry, which is the likes of those other companies above. And NVIDIA itself has gained 145%. And that's probably attributable to the 112% gain in earnings over the past 12 months. So that's really helped drive the share price. But the share price gain has actually outpaced that a bit. So it seems like expectations for the future are even higher than the company's underlying performance. So with that in mind, there might be a lot of optimism already baked in the price, which is what we were talking about before, and we saw in these multiple articles from the Seeking Alpha contributors and the analysts at Simply Wall Street themselves. It's the business is doing really well, but the price has just risen up so quickly that it's expectations are sky high, and so the risk are higher because there's like no wiggle room for error, right? If expectations aren't met, the stock could really pull back quite significantly. So that just gives me an idea of like, okay, it's had a solid year, but just keep in mind that it's like the company then needs to back it up with performance going forward. And considering the future prospects of earnings growth of like 17% per year, doesn't seem to really back it up. So I'll get more into that in a second. And the next part I look into is about the company. Basically, like if it's a new business that I haven't looked into it before, I'll read through this just to understand what the underlying business is and what products and services it has. But I've had this stock on my watch list for a bit and I've read that before, so that's okay. I'm relatively familiar with it. So I move on to the next part. And the next part I read is the fundamental summary. And this is basically just a really high level of like the key metrics. So we can see here it's got a market cap of like 793 billion, which is huge. And has revenue of 24 billion and earnings of 8.2 billion. So nothing to turn your nose up at. And it's got a PE rate, those metrics there give it a PE ratio of 96, which is pretty high, considering the earnings growth is only expected to be like 17% per year. And it gives it a price to sales ratio of 32 times. So like I said, value, like I've mentioned in previous videos, value is really only insightful, or looking at a valuation metric like PE, is only really insightful if you have an understanding of what the future growth expectations are. So like we saw before, 17% per year in terms of earnings growth doesn't seem that high and doesn't seem to justify like a PE ratio of 96 times. Like that's incredibly high. Like if the earnings growth expectations were like 50% per year, then maybe I would consider paying 96 times earnings. But considering it's only 17% per year, it just doesn't seem to be that appealing in that regard, right? Like it seems like there isn't much earnings growth to justify it. So that's probably what those articles were alluding to. Like the gains have been huge, but might be hard to sustain unless the forecast of earnings growth really pick up and go to like 30-40% or something to really justify it. Now the next section I look at is the earnings and revenue breakdown, and this is really helpful just to give me an idea of like how the business has to spend money to make money. So here's the revenue, like 24 billion, and it has cost of revenue of 8.64 billion. So that gives it gross margins of like 64%, which is really good, right? Like that means it only has to spend that much to make that much in regards of like the cost of its product. So developing its semiconductors and its chips and everything, it costs 8.64 billion, and then the revenue it generates from selling them is 24 billion. So really like the cost of inputs relative to the price they make, the price they sell them for, is really good. So that gives it really nice gross margins and plenty of room to play with. So 64% is really good. That then leaves it with a gross profit of 15 billion, and after that it has expenses of like 7.4 billion. And this here is made up of like general and admin, like just basically the day-to-day running of the business, research and development costs, and like sales and marketing costs, like promoting its products. And that totals 7.4 billion. So after all that's been incurred, it then has earnings of $8.2 billion. So that number there gives it net profit margins of 33% or just under 34%. And that's really solid net profit margins. Like you would, that is a quality company right there, which is why so many people seem to really like NVIDIA. So that there is not only why it's a popular stock, but it's also like why it probably has also attracted such a high valuation, because it's so profitable at generating money, right? It's so good at generating money. And so I'll look into that more in the sections below, but basically that gives me an idea of the underlying business performance. And the last thing I check out here is just the debt to equity ratio, just to see how leveraged they are and how much they're utilizing debt in order to fund their business. And it says 46% here. So anything above 40 is considered pretty high. But what I'll keep in mind is I'm going to look at the cash balance lower down and see how that impacts the debt to equity ratio. But 46% is, relatively leveraged, nothing to be too concerned about, considering especially how much money they're making. But I'll get more into that in the financial health section. But it seems to be okay considering it has like 6 out of 6. So I'm sure everything is okay there. And then this part here is what got my attention in the first place, the dividend yield. So the current dividend yield is 0.05%. And that's very, very, very low. The payout ratio is 5%. Like that means they're reinvesting, or they're holding on to 95% of their earnings and reinvesting that in the business. So given the opportunity they have in front of them, like being, the metaverse and gaming and data and all those opportunities, it makes sense for them to reinvest a whole lot, right? Because there's a huge opportunity in front of them. It doesn't make much sense to pay much out to shareholders. So in that respect, I'm pretty okay with that. But just in terms of like being a dividend stock, that's probably why it doesn't receive much of a score there, but we'll get more into that later on. And so if I do want the dividend stock, I have to buy it before the 1st of December. I have to be an eligible shareholder before the 1st of December. And so, yeah, that's just something to keep in mind. So the next section I look at is the valuation part. And as we saw, it passes none of the 6 metrics, so it seems like it might not be the best value. And yeah, as we saw, it trades at a P of like 96 times earnings, and that's pretty high considering the expected earnings growth rate. So this here is the simply Wall Street estimate of fair value, right? Like it's got its own model. It's based off analyst estimates of future free cash flows, and then it extrapolates out a few more years of growth and discounts all those future free cash flows back to today's present value to give us a fair value. And I know that these inputs are based off those analyst estimates with a few particular inputs. And now one thing I want to stress is that I may have different assumptions, right? So I've said this in other videos, but like I may think a different discount rate is necessary, or I may think a different perpetual growth rate is necessary, right? Like I may think it's going to grow in perpetuity after the next 10 years. I may think it's going to grow in perpetuity at like 3% or 4% per year. And if that was the case, that would significantly increase the fair value estimate, right? So that's something that you need to keep in mind, where it's like this valuation here is done with these inputs, and you don't necessarily have to agree with them. It's just showing you how the calculation was done. And the same thing with the discount rate. I may think that's too high. So I may think, oh no, like a 5% discount rate is much more appropriate. And same thing, if I used a lower discount rate, the valuation would increase significantly. So that's something to keep in mind. And also just something to look at is similar to another video we did before, but it's like this is the analyst estimates out for the next couple of years. And we can see how many analysts provided forecasts for this free cash flow that it's expected to generate in the future. This is the average of their estimates. Some are more optimistic and some are more pessimistic, but we'll get to that in a second. And then this is the extrapolation of those estimates for the next couple of years going out. And so you may think, oh, well, actually, I think its growth in the year 2027 to 2031 is going to be much higher, like 20%, 15%, whatever per year. And that, again, would really change the valuation. So one thing to keep in mind is if you do want to do your own model where you change your own inputs, you can create your own Excel spreadsheet and basically then run the numbers that they've currently got in here to get the same valuation, and then tweak them slightly based on what research you've done on the underlying stock, right? Like you think the metaverse space is going to be huge and it's going to really impact this business's growth potential. So I think it's going to be growing heaps in 2027 when like the metaverse might take off heaps. So that's what you can do. You can then change the inputs to be like, no, I think the growth rates are different, and that'll give you a completely different valuation. So just something to keep in mind, but that's how this valuation was achieved here. Looking at that data, it's good to know the context of how the number was achieved, and it seems that like investors generally are willing to pay a higher price because they think that the growth is going to be so much higher than what's in this model. So that just gives you some context as to like, okay, if you use these inputs, that's what a fair value would be to pay today. But if you use different inputs, which it seems like the whole investing community is right now, if you expect higher growth than what's expected, then yeah, today's price might actually be fair. So that's just something to keep in mind. So in this case, it doesn't pass these checks, and it doesn't seem to be the best value. Now the next thing I check is also the price to earnings ratio, and basically just comparing it against the market and industry. So I can see here that it's actually trading at 96 times like we saw before, but compared to the industry, which is trading at 30 times, and the market trading at 17 times earnings, it's very, very highly priced. But later in the future section, we'll get more context on that because we'll see what their expected growth rates are. Like we'll see what the industry is expected to grow its earnings at and what the market's expected to grow its earnings at, and see if there's any correlation as to those valuations versus those growth rates. But just looking at this valuation itself, it seems like it is expensive compared to them. And the price to earnings growth ratio, that isn't too meaningful to me here, so I'm not going to refer to that. And same thing with the price to book ratio, not too meaningful to me, so I'm not going to refer to that either. And the next thing I look at is, like I said, the future growth section. So as I said, earnings growth is only expected to be like 17% on average from all the analysts covering it over the next couple of years, and there's 42 analysts covering it. So fairly wide range of people looking into it. Now, this chart here is the earnings and revenue growth forecast, and what I look for here is basically just to see if there's any underlying trend that's occurring, and then just more detail of how the particular metrics are performing. So as I mentioned, these here are the analyst estimates. It's the average of the analyst estimates. So as new data comes out and new business developments occur, like new product lines and new agreements with particular other businesses, these analysts will then change their models. And so if all the analysts start changing, as the analysts continue to change their models, these forecasts here, or these average of the forecasts, will change as well, right? And so that's something to keep in mind. It's worth reviewing this future section pretty regularly because of that. And another thing to keep in mind is the valuation section you just saw with the discounted key free cash flow. It's based off analyst estimates as well. The first 5 years are based off those analyst expectations. So if these change, that will change as well, and you get to see how the valuation changes. So that's not static, and neither is this. They'll keep changing, so they're worth keeping an eye on, because if all of a sudden analysts become really optimistic and expect like 30% growth per year in earnings, then these estimates and that valuation will change significantly. So just something to keep in mind. But I basically look for like an underlying trend here and see if there's anything I can decipher. And it just seems like the company's got plenty of opportunity ahead of it. Earnings and revenue and free cash flow and cash from operations are just moving up and to the right. And so it seems like that's already baked into the price, though, considering so many people are willing to pay such a high price for it. They are willing to pay up because they expect a lot of growth. So the next part I look at is what I was talking about with the comparison from the company to the industry and the market. So we saw that the company is expected to have, or we can see here, sorry, that the company is expected to have high earnings growth, and it's actually expected to surpass the industry and market that it's in. And the same thing with the revenue, right? It's expected to grow its revenue faster than the industry and market that it's in. Now, the thing that I want to keep in mind here is the players in the industry, in the US semiconductor industry, were trading at such a lower multiple. Like, what was it? It was, I've already forgotten. It was 30 times earnings, right? And they're expected to have 15 times earnings growth. So if you ask me, paying 30 times earnings for 15% earnings growth, or paying 96 times earnings for 17% earnings growth, I think I might, if I'm looking for a better value deal, I might actually look at the industry, because that seems like a bit of a more fair valuation to me. So, I mean, and then on top of that, even you've got the market, which is only just slightly below that, trading at 17 times earnings. So what I take away there is that, like, while NVIDIA is a high growth company, it's like there may be better valuation prospects out there in the market industry that's in. So I might add a few more of those companies to my watch list, like Intel and Broadcom, and look into them and just see if they offer a bit of a better combination of value and growth. And same thing with the revenue, seems to be a similar situation, right? Like NVIDIA does surpass them significantly, but considering they're trading at such a cheaper multiple, it might be a better opportunity. So just something to keep in mind, that what I'll look into further, and if you're in the same situation, it would be something you'd want to look into further as well. So it passes a lot of these checks, beating the market in terms of revenue and earnings, but it doesn't pass the high growth check, being above like 20% per year. It just is growth, but it's not high growth. Now, the next part I look into is very interesting. So this is the earnings per share growth forecast. And you get a bit of insight here by looking at basically the range of analyst estimates. And I'll just quickly cover like why that's important. So this blue line here, the thick blue line, is basically the previous earnings per share results for the last 12 months. They're trailing 12-month figures. And the blue shaded area is the analyst range of estimates for that period, those periods. Pardon me. And I can see here that it's actually outperformed the analyst estimates these last couple of periods here. Then was in line with estimates here, and actually outperformed estimates back here in like mid-2020. So that tells me the company has like a history of being able to beat analyst estimates, and it actually has in its most recent earnings result as well. And what I want to look into now is the future forecast, right? So from here onwards, this teal blue line is the average of the analyst estimates, and the teal shaded area is the range of analyst estimates, right? So the most optimistic analyst has earnings per share estimates of like $5.90, and the most pessimistic analyst has estimates of like $4.27. So regardless of whether you're the most optimistic or the most pessimistic analyst here, they all seem to expect some sort of growth, right, from the $3.26 that we've seen right now for the trailing 12 months EPS. So what I do here is I go and look at the underlying business, right? So I read the gaming business and how that's going. I read the data center business and see how that's going. I look at its future prospects. I look at the industry prospects. I look at how I try and decipher how much market share I think NVIDIA might have in those areas in like a couple of years' time, especially like by the end of 2024. And then with that data and a bit of other research into like just the metaverse and like new industries that it could enter, and ultimately how much its earnings I think will grow, I can then form my own judgment on how much I think earnings per share will be by the end of this year. So I may think earnings per share actually really understated, right? Like as in expectations are subdued, and I may think that they're more likely to be like the $5.90 mark or even higher. And if that's the case, then I may think today's price is actually relatively fair, right? Because the price that you're paying is actually probably got like these as the expectations, so it seems a bit overvalued. But if you're expecting earnings per share much higher than this, then I may think today's price is actually fair, right? Same thing with the pessimistic expectations, but on the reverse, right? If I look at the same business developments and everything, and I dig deep into it, and I'm like, nah, I don't think it's going to grow as much as everyone thinks it's going to grow. Then I could look at this and be like, yeah, I think that's likely where the earnings per share are going to be, or even lower. Then I'll look at today's price of where it's trading right now, and I'll be like, nah, like not pay. It's way too expensive considering I don't think it's going to have as much growth as everyone does think it's going to have. So that's what I come back to here, right? And that's a really interesting or really important takeaway to have, because you don't have to agree with all the estimates that are out there. It provides you context of what they know about the business and what they think is going to happen. But as you do your own qualitative research and look at the underlying business, you can then form your own judgments of where you think it's going to be in those couple of years and what its earnings are going to be. So that also gives you context. Like I said, valuation and future prospects are like incredibly tied together. Like they are tied together. There's no other way of looking at it. Without knowing the future prospects, you just can't have any context on the values. So this is a really important aspect to look at, and that's what I use that section for. Now this part here, I just look at how well the company is expected to allocate its equity in the future. And so its industry is expected to allocate shareholders' equity and get a return of like 16% per year, which is pretty average. Like anything over 20% is good, so 16% is mediocre. But the company is expected to have return on equity of like 38% in 3 years' time. And that's huge, right? Like that's really good. That means for every dollar of equity they allocate, they're generating a return of like 38% on it. And that's just awesome. So really good to see that the company is expected to, in 3 years' time, have really good investments, really good like prospects where it's allocating its money to profitable initiatives. So good to see, right, that they have plenty of things to invest in. Now, the next part I look at is just the past performance, and I just want to see like how the track record's going and if it's a solid business or not. And as I mentioned, I've been monitoring the business, so it's been meeting and surpassing my expectations. So it passes 6 out of the 6 checks here, and it's just good to know because it's like having an understanding of the company's past performance. You can get a bit of context about, or get a bit more context about how to make future forecasts if there's some sort of trend that's occurring. So here we can see it's got historical earnings growth of like 22% per year. So that's really good. Good to see. And you can see here it's just been like up and to the right. So there was a bit of a slowdown here in both revenue and earnings in basically late 2018 to like mid-20 or to start of 2020. But ever since then, it's just skyrocketed. And that's probably why the share price has done so well as well. But just really interesting to see that it has like a solid track record of basically earnings and revenue trending up and to the right. And for that matter, we can see the same thing has been happening from cash flow from operations, which is like cash from its core business, and the free cash flow from the business as well. Now, if you're unfamiliar with free cash flow, it's basically like there's two things. There's accounting profits and there's cash profits. And accounting profits is like the earnings or the net income you'll see on the company's income statement. And that can be impacted by things like non-cash expenses, which is stuff like depreciation, whereas the free cash flow is like cold hard cash that's received at the end of the period. So it's good to know that a company has good cash conversion, and it looks like that's why the company passes the check here, because high quality earnings, basically what we assess here is like if the company has any big one-off items that are impacting its financial results, or if the company has like poor cash conversion where its earnings aren't that similar to its free cash flow. So there's some sort of discrepancy there where it doesn't have a good ability to generate or convert its earnings into cash. But in this case, it does. It's really a really solid business. So that's good to see. And the profit margins have just been increasing as well like crazy from 25% to 33%. So great to see that it's improving its margins as well. Now, the next part I look at is the past earnings growth analysis, very similar to the above future section that compares to the industry and market, but this is just backwards looking rather than forwards looking. So I think the reason why the stock has performed so well is because it has outperformed the industry and market in these same respects, right? So as we saw, it's gained like 145%, but it's substantiated because it has had such high earnings growth compared to the industry and market, and it's had such high earnings growth over the past 5 years compared to the earnings and market. So when you compound this over 5 years, 22% versus 15, it makes a big difference, and that just seems to be why this is such a high quality business. Like earnings are trending upwards, accelerating growth, and basically it really outpaces the industry that it's in. So really solid performer there. Now these next sections I look at here are just profitability metrics to know how well the company is like allocating its capital. So the one above was the future return on equity, and this one is the current return on equity, right? So how well is it currently allocating shareholders' equity to generate a return? And it's doing pretty well because it's very similar to what it's expected to be in the future, right? So 34% is really solid. Anything above 20 is considered good, and 34% is really, really nice to see. So good to know that it's got profitable initiatives that it's investing in right now. And compared to that to the industry, where it's 16.5%, it's even better, right? So 16 isn't that good. It means the other players aren't that profitable, or they're not allocating their shareholders' equity as profitably. And the fact that it's better than them is better than their allocation is just another tick of approval, right? So it's good to see how well it's allocating that money. Similar aspects here. I want to see how well the company's got generating a return from its assets. Now, it's not too meaningful to me here to look at the return on assets given the nature of NVIDIA's business, but it's still interesting to see that it's a strong metric and it's outperforming the industry, right? So 20%, it's not an asset-heavy business, but it's good to see that it's like generating a return on assets of like 20%, and that's far outpasses the industry average of like 10%. So good to see in that respect too. Also probably contributes as to why it's trading at such a premium. And same thing here with the return on capital, but the trend doesn't seem to be going as well, right? So last year the return on capital was 23%, which is good, like it's solid, but 3 years ago the return on capital employed was 37%. So it's actually been trending downwards, not the ideal trend of what we want to see. So I'd like to see if that actually improves. Now, return on capital employed is basically total assets minus current liabilities, so it shows how the company uses debt as well. And it seems like it's been decreasing as of late. So I wonder if it's been because they've been paying off debt or what's been happening. So I'll get some more color on that in the financial health section, but still just interesting to know that it's actually been trending down. So I want to keep an eye on that. Now, the next section we look at is the financial health. And what I want to see here is basically just if short-term assets, being like cash and cash equivalents, can cover short-term liabilities and long-term liabilities. Because ultimately, short-term liabilities is stuff like accounts payable, like any liability that needs to be paid within 12 months. Because if there's some of them become due, I want to know that the company has like a cash buffer to be able to pay them and isn't like short on cash to pay its debts. And long-term liabilities is stuff like much longer-term contracts, could be like rental agreements and stuff like that, that are due longer outside of 12 months, right? Like longer-term periods. So good to know that the company has plenty of cash on hand to pay any of these if they were to come due for whatever reason. So very solid cash position in that sense, a liquidity position in that sense. Now the next part I look at is just the debt to equity history, and I just want to see how the company's been utilizing debt in its capital structure. So I can see here that the company did have a bit of debt for a while back here in the early years, not too much though. And basically, as of late, like 2020 and 2021, it's actually seems to have raised a bit of debt recently. And you can see that kind of correlates with the raise in cash. So the company's taken on a whole bunch of debt there, gone from 1.9 billion to 6.95 billion, and cash has increased accordingly. And so same thing here in like mid 2021, it's also raised some cash by issuing some debt. However, the debt to equity ratio actually seems totally fine, right? Because even though it's 46% debt to equity in terms of its capital structure, like how it's receiving its funding, it has way more cash than it does debt, right? So it's got $19 billion worth of cash and $10 billion or $11 billion worth of debt. So if it wanted to, it could pay off the debt just like that. It's very, very safe because it has so much cash on hand. So that's what this check has here, and it's just like that's a great tick of approval that it's like the company's not in any sort of risk of bankruptcy. Now the next part to look at is just like how it's been trending, and as I saw, it's like it's reduced from 56% back in like 5 years ago to about 46% now. 46% isn't too low, but it's got so much cash that it's not really a huge issue. And the coverage of that debt in terms of operating cash flow and EBITDA paying the interest repayments, sorry, not EBITDA, EBIT, paying the interest repayments is plenty, right? So really good to see that like 1 year's worth of operating cash flow could pay off about like 74% of the debt. That's good to see. And the EBIT covers the interest repayments by like 40 times. So anything above 3 times is considered good. So it can easily service the debt that it does have. And this next section here is just like the balance sheet breakdown. And I would typically look at this if there's any sort of like, or try and look if there's any sort of discrepancy in like what breakdown it has in terms of its balance sheet. So one thing I typically keep an eye out for is the accounts receivables and accounts payable. So if there's like a huge amount of accounts payable compared to accounts receivable, that's just something I keep my eye on, where like it's like, okay, they've incurred a sale, but they haven't received the cash for it yet, so it's considered an asset because they're due to be paid. Whereas accounts payable is like they've incurred an expense, but they haven't paid for it yet, so they're due to pay it, like it's a liability, they owe someone. But I can see here that it's like these don't seem to be any big issue. And then just everything else in terms of balance sheet here seems okay to me. Nothing really stands out. And so the next section I would check is the dividend. And while the company passes no checks here, on a surface level you may think, oh, it doesn't pay a dividend, but it actually does. So I can see it's got like, as we saw above, it's got a dividend yield of 0.05%, which is like incredibly low, like probably not even worth your time considering what you could get like a investing your money in like a savings account or something. So it's a very low interest rate, dividend yield. But it was just something that got my attention in the first place. So if I do want to purchase this enticing dividend yield, I have to buy it before the 1st of December, or be an owner of the shares before the 1st of December to be eligible for the dividend on the 23rd. And it's just something to keep in mind. So as we saw, like the dividend yield is so low, it's virtually nothing compared to even the bottom quartile of dividend pays, especially the top quartile. And even the industry average in the US semiconductor industry, they pay an average yield of like 1.1%. So it's much, much lower than that, not even 5% of what yield they're paying. And the forecast yield in 3 years isn't expected to be much better either, at like 0.07%. So they expect the dividend, analysts expect the dividend to increase, but not that much. So it's not exactly a huge dividend stock. And what I look for here is pretty much like this story of what I'm seeing here is the company has been able to increase its dividend, which is good because obviously that means earnings have been increasing and it seems very sustainable. And I can get more clarification of that here by looking at the EPS compared to earnings, right? So 28 cents per share earnings in 2015 versus a 9-cent dividend back then. And then earnings per share have just skyrocketed to like $3.29, and dividends per share in the most recent period were 16 cents. So they've increased over the last couple of years, but it's like we saw, it's holding on to so much of its earnings and reinvesting like crazy, which as a shareholder, not a shareholder, as a prospective shareholder, it's like that's what you'd want to see. It's like the company has plenty of reinvestment opportunities that are also profitable because we saw the return on equity is like 34%. That's a great return. And I'm like, you know what? Hold on to that money, keep on reinvesting it because then you can generate more growth, compound the business, and basically then in the future you might be able to like at a stage where it's like, okay, we don't have as many reinvestment opportunities. Here's a whole bunch of cash and just returns all that cash to shareholders when they don't need it. But at the moment, it seems like they do need it because it's a really competitive space, requires a lot of investment, and it really would be like a situation where like if they've got a dominant position, they're like the go-to player in that sense. So this is basically just telling me how the dividends have gone, and nothing's really too surprising. They're holding on to a lot of their earnings and paying out a very small portion of it. One thing I am just taking away from this is that it actually sort of seemed to be a dividend stock back in the day. So see this 2.4% yield at 2013? That's pretty good, right? So like it was only paying out 7.5 cents a share back then, but as the share price has increased significantly, this dividend yield has really decreased, right? So look, it's now the 0.05% that we've seen. Pardon me, but that's because the share price has increased so much compared to the rate of dividends per share. So nothing to be too concerned about, but like if you were to purchase back then in 2013, and you're like, oh, I'm getting a yield of like 2%, compared to the price you paid back then, if you're now effectively receiving, 17 cents per share on your dividends, on your stock. And so compare that to back here, your dividends have increased like more than double. So you're effectively now like a 4% yield, at least from what you paid back then. So that's just something to keep in mind with the whole idea of dividends. You want to see that a company is able to continue to grow them and pay higher dividends in the future, because based on your current price, if it's like a yield of 2%, if it's paying higher dividends in the future, your yield is now like 4, 5, 6, 7%, depending on if the dividend increases. So that's just something to keep in mind. But it seems like, the analysts who have provided forecasts expect dividends to actually increase quite significantly in 2024. But doesn't expect the yield to be that much higher. So it's just like something to keep in mind. Now, the next part I have a look at is the current payout to shareholders. And basically, it's similar to what we saw above in the fundamental summary. Just they're paying out like 5% of their earnings. They're retaining a whole bunch of them, virtually all of them, and they're reinvesting heavily in the business. And that's totally okay with me because of how much opportunity and profitable reinvestment opportunities they have within the business. So totally fine by me. Don't mind at all. Now, the next part I look at is the management section. And here I just want to look at the tenure and like the particular managers who are working within the business. And I want to see like how much skin in the game they have, just to make sure that they're like aligned with shareholders. So I can see that they've got an average tenure of 12.8 years. That's huge. Like that means they're at the business for on average more than a decade. So they've got heaps of experience. And considering the business has been doing so well, I think that's a great thing. right? The CEO seems like he's been there for years, 28 years in the role, and he's getting paid about $19 million a year in compensation. And if I didn't know the leadership team or the CEO too well, I would read through this just to get an idea of what his history is and what he's got experience in and where he's worked before. But I won't do that now. And I also just check out the CEO compensation. So I want to compare how he's been compensated to how the company's been performing. And so here I can see that basically the dotted yellow line being company earnings, they have been trending up and to the right. And it seems like his compensation, like salary, has been pretty flat the whole time. But his total compensation, which includes stuff like stock options and cash, has basically been in line with the company's earnings, right? Like when earnings declined over this period, his compensation declined as well significantly from like 13 million to 11 million or thereabouts. So it was in line with the company's earnings, and it's now increased significantly as the company's earnings have increased as well. So good to see that he's basically being incentivized and compensated in alignment with shareholders. But in regards to these checks here, because he's being compensated so generously, it seems like it's higher than the average of companies that are of a similar size. Like he's getting paid 19 million versus to the average of like 11 million for companies of a similar size. And his compensation has increased more than 20% in the past year compared to like the earnings growth. So just something to keep in mind that like he's getting paid in alignment with company performance, but it's like very generous at this stage. Now the next part I look at is just what I was saying, like the profile. I would read through all of these different profiles here and just get an idea of what everyone's been doing, like what their experience is and where they've been working, and then read through their tenures. So this is what we're talking about, like the average tenure seems to have been raised by these co-founders who have been there for 28 and a half years, and these particular people here who have been there for like at least 12, they really lift the average tenure, but that's nothing to be frowned upon. It's like good to see that they've been with the business for so long. And their compensation is just just look at this to try and get an idea of how much they're paid. And then in regards to the ownership, I just want to see how much skin in the game they have. So for those that have data, it's interesting to see if they have, like, considering the size of the business being 790 billion, you want to see they have like at least a few $1 million invested. And in this case, they do. So they've got like 140 million, 80 million, 125, 194, $27 billion worth, 19 million. So these managers here are very aligned with shareholders, and this is just their personal holdings. They could have holdings in like entities and trusts and companies and stuff outside of here, which is very hard to track. But this stuff here tells you that in their own personal name, they have a lot of skin in the game. So that's really good to see, because if you're a shareholder, they're likely to make the decisions that benefit you because they're also a shareholder themselves. So good to see that they are. And yeah, like I said, very experienced management team, very long tenure and time in the business. Same thing with the board members. What I would do is read through their profiles and just get to know them, look at their tenures, see that they've all been there for at least a couple of years and how they're compensated. And then same thing, see how much ownership they have. So how aligned are they with shareholders? And it seems like there's a lot of people here who have at least a couple of $1 million invested in the stock. This person here just has a couple of 100,000, but still that's a fair bit. But yeah, a couple of $1 million here at least, or billions in some cases. So good to know that they have plenty of skin in the game, so they're incentivized to make decisions that are value accretive to shareholders because they are shareholders themselves. So big tick there. Now the next part I look at is just the ownership, to see who like the biggest shareholders are, and then just seeing if there's been any buying or selling. So I was reading that article before, and it gave me a bit of an insight into the overall insider selling that's been occurring. And they basically was saying there wasn't anything too concerning. Like, the trends I basically look for here is if there's any sort of large trends of like huge sales from multiple different insiders, like huge in terms of a proportion of their holdings, and multiple insiders doing the same thing. Because if there's like a big trend of many insiders selling large amounts of stock, that's a big red flag of like, okay, why is everyone offloading stock? That's something to look into. And then same thing with the shares bought. It's like you want to look for if there's some sort of trend of like massive amounts of insiders buying shares and buying large amounts of shares, because that's also a signal that like there's something that they're all clearly bullish on, so it's something I should look into. So yeah, it's interesting that they've been selling shares, but as I mentioned, that article kind of provided me with context as to why they were selling. So the next part I look into is the ownership breakdown, just to see who has the most say and influence of the company. And it seems like institutions have almost basically 2/3 of the voting rights here, and the general public has about 1/3 of the say here, and individual insiders own about 4% of the stock. So that's pretty much telling me that institutions have the most influence over the stock. So when it comes to votes at AGMs, they'll basically have the most say. And the next part is I just want to check if insiders have been diluted any recently in the past couple of years, in the past year. And in this case, they haven't, which is good to see. So something to keep in mind there is like if a company has been issuing shares heaps in terms of like stock options or like issuing shares to raise money for new projects, it's bad to see if it's been diluting shareholders, because ultimately then if you're a shareholder, you own your slice of the pie is now smaller. So just something to keep in mind. And the next part I look at is just the top shareholders, and I just want to see like here's the breakdown of all those institutions that we saw and the individuals who own a fair bit of stock. And I just want to see if they've had a large change in their shareholdings over the last couple of periods. So we can see how much stock that they own in terms of like the current value. And I just want to look for any big changes, right? Like 5, 10, 15, 20%, if they've been like offloading or loading up on stock, because that could be a signal that they think they have a strong conviction in some sort of decision of like all of a sudden they're really bearish, all of a sudden they're really bullish for whatever reason. So in this case, having a look at it, I can't really see any huge changes in anyone's holdings other than this particular shareholder here reducing their holding by like 13%. So, I mean, to be fair, it says as a part of their portfolio, it seems to make up 0.99%. So it wasn't exactly their biggest holding, but it seems like they've just been trimming back since the share price has been appreciating so much. But yeah, this shareholders added 44% to their shareholding, and it's about 1.25%. So they're very bullish on the stock. But I just look for any overarching trends, like if there's any multiple people doing it, or and just try and see if there's any sort of clear trend, of multiple shareholders doing it. But yeah, so that's pretty much the whole company overview there. So while the dividend coming up is soon, while the dividend is coming up soon, basically I don't find it enticing enough to buy because it's such a low dividend yield, right? Like it's 0.05%, and ultimately that's incredibly low yield, and it tells me that there's actually better opportunities out there because the industry has a yield of like 1.1%. So the share price has appreciated so much recently, the dividend yield is really low, and like it has a solid balance sheet and great past performance, but the future prospects just don't seem to be that high in terms of growth, and the dividend doesn't seem to be that high considering the price you're paying for it. So from that respect, I'm going to keep it on my watch list, and I think what I'll do is just continue to monitor the stock. Like I'll wait for some weakness in case there's like a better opportunity to purchase, because the current PE of like 96, from that perspective, like an earnings growth of like 17%, just seems too high to pay. So in that regard, I'm basically going to sit on the sidelines and keep it on my watch list and just keep monitoring the updates that come through. But my next steps is I'm going to have a look at the other semiconductor players, because I'm still very interested in the space given everything that's going on with the metaverse and gaming and data and stuff. So I'm going to look at the other semiconductor players and just research them and see if there's any other opportunities out there. So yeah, that's pretty much the full overview of how I would go through NVIDIA and my next steps of what to look at. So I hope that's been helpful, and thank you so much for watching.